Welcome to Morning Markets. I'm Lindsay Biscaya. Let's get to some of the stories we're tracking for you in the BNN Bloomberg newsroom today. Canada's economy lost nearly 25,000 jobs in the month of January. Economists were expecting a gain of 5,000. Now, according to Stats Canada, the country's manufacturing sector was hit the hardest, with U.S. tariffs continuing to weigh on the industry. January's job loss marks the steepest decline since August of last year. And shares of Stellantis are down sharply today after the automaker says it is taking a more than $25 billion write-down linked to its shift in EV strategy, currently down more than 22%. Stellantis is also selling its stake in a battery manufacturing plant in Ontario to LG Energy Solution. The plant was established in 2022, and under the terms, LG will hold full ownership of the facility. And shares of OpenText are trading higher after the Canadian software company topped profit and revenue expectations in its latest quarter. Cloud revenue also came in above estimates and saw an increase of nearly 4% compared to the year before. The quarter also got a boost from better than expected revenue in the company's content management unit. And we'll take a quick look at the markets, starting with the TSX. It is up by more than a percentage point, driven mostly by materials stocks today is what we're seeing. If we take a look at the U.S. markets, it's a little rosier than the last couple of days. It seems investors buying on that dip from that sell-off we saw earlier this week. The S&P 500, Dow Jones, and NASDAQ all trading up at the moment. The Canadian economy shed almost 25,000 jobs last month, with the largest employment losses in manufacturing as U.S. tariffs continue to take a bite out of that sector. Let's break down the latest data from Travis O'Rourke. He's president at Hayes, and he joins us in studio. It's good to have you here.
Good to be here.
So what do you make of almost 25,000 jobs lost in the month of January? What does that tell you about the economy?
Yeah, this data is wild. You can kind of, it's a bit of a yo-yo. So we've got Ontario hammered, down 67,000 jobs. Then you've got Alberta up 20,000. Good. You've got part-time jobs down about 70,000, full-time up about 50. So we like that. Then you've got private sector goes down 50 and public sector goes up. So you can kind of interpret the data or look at it if you want to feel good or if you want to feel bad.
Is that normal to see? Like, because usually it's either pretty dire or looking pretty optimistic.
Yeah, I'm an optimist. I like to see full-time jobs go up.
Yeah. If
someone's going to go down, it's definitely the part-time. But I think this is a smoky kind of report here, where we've got unemployment going from 6.8 to 6.5. On the surface, if you just read that headline, you'd say, good, we're moving in the right direction. Then you see we lose 25,000 jobs. But the most worrying part to me is we had 92,000 people exit the workforce, as in they're no longer looking for work. And that's really what's moved it from 6.8 down to 6.5.
Why have so many people exited the workforce? Like, what does that tell you?
You know what? It tells me probably two things. Okay. We are in a low hire, low fire market right now. And if you are out of work and you're looking for work, it's not a good place to be. A lot of people have run out of steam, quite simply. Other way to look at it, maybe you've got a lot of people looking for seasonal work in the holiday season coming through December. We saw that part-time go down. Probably the biggest fear I would have would be if we've got a real skills mismatch. And we've actually got a lot of people who've been trying to look for work for a long time, and the jobs that are available, Canada just doesn't have the people to fill them. And when you work in employment like Hayes, we do see a pretty big skills mismatch, and hopefully something Canada can address over the coming years.
I want to talk about the full-time and part-time, as you mentioned. Like, full-time was, there was a few jobs added in full-time compared to the last month.
Yep.
Part-time, it was down. What does that tell you? Is that something to be concerned about?
I would say we'd be more concerned if it was the other way. If companies were shedding full-time talent and they weren't quite ready to commit on a full-time replacement, that would be worrying. Anecdotally, we've noticed in 2026, people are a little bit more optimistic about hiring. I would say people expected a lot worse in the back half of 2025. But the big issue we've got right now, and we saw it in the manufacturing jobs, is our battle with the Americans. You can point to the tariffs for sure. Obviously, some scary statements coming out of Davos, 100% tariff coming to Canada. But for me, the biggest one is CUSMA. And if you're an executive and you're in manufacturing right now, or if you're in many spaces, how can you responsibly invest money when they're threatening CUSMA as a major challenge for us in the second half of 2026. So we're a bit of a wait and see moment. I think we saw that in the manufacturing data.
Yeah, I mean, because obviously manufacturing, like we just saw GM lay off 500 employees, so that's not good. That's not even in the January numbers, really. I mean, it might be included, but is this, as you talk about like CUSMA and that uncertainty around the ongoing trade war, is it like businesses are just not feeling confident hiring people right now too? Is that part of it?
Yeah, I think you're in a wait and see. And when everybody thought, okay, things are improving, we're going to get a good deal done. And then obviously we had the announcement of the EV imports we're going to do with China. And that sent the auto sector kind of, into a frenzy. And then we saw the Americans respond and say, like, look, if you're going to do a deal with China, then we're going to hit you with an additional tariff. And that's a bad idea coming in to negotiate with us for CUSMA. So if you're manufacturing in Ontario right now, like, again, it's difficult to invest in that market.
I don't know if because you did talk about the different provinces, right? Like Ontario saw losses. Did you see Alberta saw some job gains? Like why? What sector is hiring?
I think Alberta's in a beautiful place right now. Like they're moving from Canada's gas station to Canada's hard drive. Right. And the investment that they're putting into data centers right now, what do you need for data centers? You need a lot of cheap land, check, and you need the energy to power the data center. And Alberta has both. They've also got a low tax environment. They've got the highest immigration rate of Canadians moving across provinces. It's a beautiful place to be right now if you're in Alberta. And I think that province is managing it very, very well. So up 20,000 in Alberta, I think we're going to see that trend keep going through the summer.
Interesting. What about AI? Like there's the constant narrative or fear from some people that AI is going to take away jobs. Are we seeing any of that in the data that's released today? Or is it, like you say, with data centers that are needed, you actually get employment?
Yeah. You're both.
It's both.
I'll touch both. So let's say, are there people losing jobs?
Because of AI?
Kind of. I think there was data that came out last year, only 4.5% of job losses were actually directly related to AI. We've got a lot of companies investing, but only 56%, according to a PwC survey, of companies are actually seeing the productivity gains. So there are jobs being replaced by AI. Quite frankly, I think there's more AI washing, I would call it, happening out there, where CEOs are going through layoffs and they're attributing it to productivity gains or investments tied to AI. It's a lot easier to say we're investing in the future and we're getting more productive than it is to say I mismanaged a macro environment over the last year and now we're cutting jobs. So there's a little bit of,
So putting the blame on
a little bit, a little bit, and giving themselves a pat on the back for investors. But when you look at Canada, something that I refer to kind of the left side of AI, where you need energy, you need minerals, you need mining, you need electricity. Canada's got a lot of that kind of naturally where we can really benefit from AI. So some of the gains we saw in utilities this month and the gains that we saw in Alberta, I think AI, if you look at before the application actually comes live, we're in a good place to actually gain.
So you think maybe it's looking more optimistic in the next couple of months?
I would say it's looking more optimistic in the next couple of months for full-time hiring.
Okay.
But until we get CUSMA, it's buckle up and hold on to that auto sector, Ontario, because it's going to be a ride. It's
going to be a rough ride. Okay, Travis O'Rourke, always good to have you in. Thanks
Pleasure.
so much.
Cheers, Lindsay.
Up next, we will get more reaction to jobs data, of course, and we'll get more insight into the latest in the market. So stay with us. Welcome back. As we continue to digest Canada's latest jobs data, let's get an investor reaction to those numbers. And we're joined now by Kelsey Keane, Director of Equity Capital Markets at the National Bank of Canada, joining us in studio. It's good to have you in. Thanks so much.
Pleasure to be here.
So I'm wondering, like, as you probably heard Travis O'Rourke just talking about how you can look at these numbers that were released today and you can look at the positives or the negatives because there's so many differences in them. What are you looking at? What's your takeaway?
Yeah, so as you mentioned, the composition of the data isn't as bad as the headline number looks. There were positive gains in full-time employment, which is strong data. I think investors will be looking at how does central bank policy react to this data? And what's really interesting is they're going to have to decipher between some of the structural changes in the economy. So that's tariffs, that's a slowing growth in population in Canada. And differentiate that between cyclical changes.
So what do you think they will do? Because obviously the labor market is a huge factor into what the Bank of Canada decides to do with rates.
Yeah, right now the outlook is still to remain stable in the near term. And I think it will be very data dependent. There's a lot of economic data to come out before the next meeting on March 18th and further on throughout the year.
You say too, like the silver lining was full-time jobs are up because we're seeing full-time jobs up,
Yep.
part-time jobs down. You know, some analysts are saying that's just noise. Do you think that's actually something we should focus on, especially the part-time aspect of it?
Yeah, and once again, I think the takeaway there is positive. I think full-time is really the heart of the employment number. I think part-time, I think that's, once again, it's employers' confidence around everything that's happening around trade negotiations and just the broader economy in general.
Okay, so let's move on. There's exciting developments in Canadian IPO
right.
today. AGT Foods announcing that it is going to go public again.
Yes.
What do you make of this? I mean, they say, you know, they can raise $336 million in an initial public offering. Do you think that's realistic?
Yeah, so they filed their prospectus yesterday. It's actually for a $460 million IPO. Oh. So, yeah, you know what? It's really interesting. I think we should look at the backdrop of what's been happening in Canadian IPO markets over the last 3 years. We've seen over $100 billion of small cap Canadian companies get taken private. And that's actually shrunk the small cap sector. And it's made it harder for small cap Canadian investors to have a place to build a strong portfolio within these markets. So when we see a strong Canadian name like AGT Foods looking to list publicly, I think that's a really exciting development in the market.
They were taken private, though, I'm not sure how many years ago. What was there a benefit of being taken private, do you think, for this company?
Yeah, so I think being a public company, there's a lot of scrutiny. So there's quarterly reporting, and you're constantly under the watch of the market. So I think when companies look to go private, I think there's a couple things happening. For the buyer, they're looking probably at a company that they see more inherent value in. And an opportunity to buy that and then potentially monetize in the future. And then the other thing is it gives a company under being private more time to recalibrate and build up a strong, resilient business. And then go public again. Okay, let's look at the markets now and talk about what we're seeing with the markets today. It's been an interesting week for North American markets, right? It's a lot of volatility out there. In terms of what we're seeing today, the TSX is up. U.S. markets seem to be going up again. What do you make of why we're seeing that kind of resilience today, I guess? Yeah, so it definitely a rough start to the week. Yes. We saw a big rout in tech and the materials sector. So I think it's, by the end of the week here, I think investors are looking at maybe some of the sell-off as being a bit overdone. During the week, too, we did see a lot of sector rotation. So we saw, the sell-off in tech and materials and more investing into consumer staples, consumer discretionary. And a lot of that was just the shift in the risk-off tone. So I think today we're looking at kind of a stabilization in what those outlooks are. How do you think investors should look at that, though? It's hard to predict the future, especially now, but are we in for a bit of more volatility moving forward? Where should investors look for a little bit of a safer bet? Yeah, so, exactly what we talked about. There's certain things, certain areas of the market where you can look. So more of those staples, utilities, those are great places to put your money. Also fixed income is another place that people look to put their money. I think we can expect volatility, just everything we have going on geopolitically. But still, what's interesting, I would point to the volatility index. It's been relatively stable, even amid all the economic changes and all the news that we've been getting over the last, more than just the last year. But so that shows that there is an underlying strength that investors do want to keep their money. Right. Okay. We will leave it there, but I appreciate you coming in studio. Thanks so much for joining us today. Thank you. That was Kelsey Keane, Director of Equity Capital Markets at National Bank of Canada. Coming up, after a volatile week, which we were just talking about, driven by AI and spending concerns, markets showing a bit of a rebound this morning. We've got even more on that when we come back. Stay with us.
It has been a volatile week on the markets. Investor concerns over artificial intelligence and aggressive spending weighed heavily on stocks. And for more, we were joined earlier by Patrick Horan, principal at Agilith Capital.
We did see some confluence of what was the setup was, a fantastic market over the past 3 years, especially for software, and with the assumption that the future looks as rosy as the past, and markets don't actually cooperate like that way. So there was a high degree of contrarianism that could end up disrupting that. And what we've seen is AI put into question the very basis of what the software models are all about, which is high moats, high barriers to entry, and very sticky customer bases. And so that is really shaking the confidence of the past thoughts and these multiples that software companies, SaaS companies have demanded, have really been through the roof. Like they were. It was reminiscent to me of the .com era, of just how much momentum had been built in, how the high growth rates and the high expectations that these models would give. So, so the setup was, that hey, we've got everything's coming up roses, and it's just going to continue, and that's. And now we have a big question mark in the basis of these business models, and we are also on the side of that skepticism, by the way, in terms of questioning the business models.
Okay, I mean, it really just goes to show too how fragile the sector is. Some of these companies are when it comes to like a big competitor coming out with a tool and the rest of the stocks kind of plunge. On that note that you just finished with, though, I mean, we're talking about aggressive spending a lot this week. We've seen some of the companies come out with some overspending. You're talking about like Amazon, Alphabet, and investors appear to be concerned about that. Is that valid?
Yeah, it's absolutely valid. The pace of adoption, I just want to make sure everyone understands this, because it's at a hyper scale that we haven't seen before. The radio took 20 years to get into everyone's homes, and television took 10 years, and the internet was 7 or 8 years, and cell phones were that much. We're talking about AI being available to everyone who has a cell phone instantly, and you've got 500 million people already using it, and it's barely a year old. So I think that adoption rate is really one of the fastest technology adoption rates that we've seen. So the possibility of change here is immense, and I think it's you have to look at this and go, okay, what is the future going to be all about? And what we know is that the AI is going to be a better search tool. Certainly, it's going to bring more customization, and it's going to be hard for the old digital economy to compete with that going forward. So yeah, absolutely. There's a big question mark in what do the software companies of the future actually stand for? How do they maintain that sticky moat?
Yeah.
Because there's cracks in it already.
I want to switch gears here just before we have to take a quick break and talk about the January labor force survey coming out today for Canada. It's coming out at 8:30. We'll be breaking those numbers on this show. But I'm wondering what you're expecting to see. Like I know some analysts were saying that they expect, the trade uncertainty to dent hiring for the month of January.
Yeah. Yeah, I think it's it's funny. Canada's kind of we joke about it's a random generator of numbers. It's very hard to get a consistent read. But our thoughts are that immigration is down, and we our birth rate is we barely support our population between the immigration we have. So we're expecting low numbers. over the long term. We think we've switched from high immigration to low immigration, and as a result of that, our labor force just is not going to be as strong, and we just have to mentally prepare ourselves for that. So it could be 10,000, 20,000. That would be a very optimistic number in our view.
That is Patrick Horan, principal at Agilis Capital. Well, an Ontario woman wanted to make some extra money by doing private lending, so she took out a line of credit on her house. It was going well as she was getting interest payments each month. However, they've now stopped, and she's worried her $150,000 may be gone. CTV's Pat Foran has more in this report.
It was a relief. It was financial freedom, I thought.
Deanna Johnson of Whitby is a single parent with 3 boys. She has a full-time job and works part-time to pay the bills. That's why she was interested when she heard she could earn income providing loans.
I found out about private lending through social media, Instagram Reels, how to get like a second income to work for you.
Johnson went to her bank and took out a line of credit for $150,000. She found a company to loan out the funds and says the first year went great. She received interest payments of $3,000 each month.
It was a financial relief, some wiggle room.
But Johnson says last year the payments started to be late and then they stopped completely. In June, she asked for her funds to be returned. She's been trying to get her money back for the past 7 months without success.
I would like my money back, my $150,000.
Johnson gave the funds to Deneen Griffith of Unifocus Investments. When CTV News contacted Griffith, she said, "We are currently conducting a full internal review with the third-party company involved. Our priority is protecting our clients and ensuring all appropriate steps are taken."
Just like anything in the world, the higher the interest rate you're being offered, the bigger the risk.
Mark Ting is a financial expert who says people who need private loans have usually been turned down by banks and other traditional lenders. He says that makes it risky, and anyone considering private lending should be extremely cautious.
I would not be comfortable doing that myself, and I probably wouldn't be recommending anybody doing that unless they're extremely wealthy on their own and they could afford to lose that $150,000.
Johnson says she is now stressed and frustrated and worries the $150,000 she lent out could be gone for good.
I feel like I'm back to square one where I started, and it's really will impact my family.
Pat Foran, CTV News.
Coming up, Canada's economy shed 25,000 jobs in January, but the unemployment rate went down. We'll get some analysis on that when we come back. Stay with us. Canada's labour market lost jobs last month. Data from StatsCan shows the economy shed nearly 25,000 jobs in January compared to the month before. The country's manufacturing sector was hit the hardest, with U.S. tariffs continuing to weigh on the industry. Meanwhile, the unemployment rate fell to 6.5%. And we are watching shares of Canopy Growth today. The Canadian cannabis company posted net revenue and profit for its third quarter that came in above expectations, with revenue hitting $74 million. Canopy says the results were driven by strength in its Canadian market as well as cost-cutting initiatives. On the downside, international markets revenue fell 31% compared to the year before. And shares of Amazon are under pressure after the e-commerce giant says it plans to spend $200 billion this year on AI data centers, chips, and other equipment. The forecast is $50 billion higher than what analysts had expected. Analysts are also noting concerns about how much big tech companies are spending on AI-related investments and when that spending will actually pay off. Okay, we'll take a quick look at the TSX here. It is trading up today, just below a percentage point at this rate. And if we take a look at the U.S. markets, kind of the same thing. All of these markets rebounding after what was a pretty tough week in the tech sector, which was dragging these markets down. But today you can see traders feeling a little more confident to end the week. Shares of Stellantis are down sharply today after the automaker said it is taking a more than $25 billion write-down linked to its shift in EV strategy. For more on this story, we are joined by Gabrielle Coppola of Bloomberg News to kind of break down this, because, Gabrielle, there was a lot in this statement from Stellantis. So what's exactly in there to focus on?
Yeah. So, I mean, the biggest thing is they had to cancel products, their EV products, because the volumes that they were hoping for and the profits, their margins they were hoping to get from that did not materialize. And Stellantis is certainly not alone in that. We saw Ford write off almost, I think, $19 billion. GM was around $7 billion. But I think what surprised people today is that the Stellantis write down was bigger than Ford and GM. And that's because it's not just EV write-downs. There's other problems in there. They've had a lot of recalls on some of their important products in the US. That creates expenses. They also are a big player in the light commercial vehicle, like delivery vehicles in Europe. And they weren't able to sell enough, so they had to pay for basically emissions compliance type things. This is what they call a kitchen sink, but unfortunately, it's like not the first kitchen sink we've seen from Stellantis since they got a new CEO in May of last year.
Yeah, the manufacturing sector is certainly taking a hit in Canada, and now we're seeing that contributed to by Stellantis. So I'm wondering then, what does this mean for Canadian investment?
Yeah, I mean, it's not a great sign. I mean, obviously, the Canadian investment tensions, you've seen the Canadian government is trying to claw back money from Stellantis because they moved a product. They were supposed to build a Jeep Compass in Brampton, and they basically, in order to appease President Trump and kind of negotiate their way out of more tariff costs in the U.S., they agreed to move that Canadian product to Illinois. So I think there's been a lot of tension there. On the other hand, Stellantis keeps saying they're going to stand by their commitments. They also have the, Windsor plant that is, has full product. But, if the company's not doing great, obviously that's a huge cloud over all of this. And they are really, the CEO, Antonio Filosa, has talked about, in order to kind of get their mojo back, to get back to positive cash flow, they need to grow in the United States. And that is where they are focusing all of their energy and what they're prioritizing, both because that's where the biggest profits are. And that's how they need to stay on the good side of President Trump. And that's coming at a cost to their relationship with the Canadian government.
Yes, part of the whole plan, I think, with the tariffs from the U.S. side, at least. When it comes to the write-down, Stellantis' write-down, you kind of touched on this already. You said it was bigger than the write-downs from GM or Ford. Why was it worse, though?
I think that, it's funny because when I think of Stellantis, a lot of they canceled EV, like GM and Ford kind of actually put more product out into the market that didn't sell. So going in, I kind of thought, oh, maybe Stellantis is better positioned. But, Stellantis, you have to remember that Stellantis is in a period of great kind of stress and transition. They basically pushed out their prior CEO, Carlos Tavares, who had really bet very big, very aggressively on EVs. And so when he left, it was sort of, they had to rethink the whole strategy. And he also, because of a lot of his extreme cost cutting measures, he really hurt their ability. It's not just about the product not selling, it's just about the internal kind of operations of the company. So much cost cutting, it's hard to be efficient. There's a lot of quality problems that have come back to bite them. And then I talked about, in Europe, they're also suffering because they're struggling with the kind of, emissions rules. There's compliance cost in Europe, even though they've gotten a big, present from Donald Trump, in the sense that Donald Trump has rolled back a lot of the tough, emissions rules in the U.S. So that certainly makes life easier for them. And it kind of gives them a ray of hope that if they can keep selling their traditional ICE combustion engine vehicles and get back some market share, they can actually pull out of this. And, you can see the new CEO, Filosa, they have a new hybrid Jeep Cherokee. That product was literally killed by the previous CEO. Now they're pushing it really hard in the U.S. They've got a whole bunch of new trucks, performance brand trucks. So that has to work. Someone said to me once, Stellantis doesn't work unless they're successful in the U.S., and that is their focus right now.
So interesting. All right, that's all the time we have. Gabrielle Coppola of Bloomberg News, appreciate you joining us. Thank you.
Thank you.
Employment in Canada edged down in January. Stats Canada says 25,000 jobs were lost, and the unemployment rate has dropped to 6.5%. Earlier, we got perspective from Earl Davis. He is head of fixed income and money markets at BMO Global Asset Management.
All else equal, this job, the headline job number down 25,000 says the chances of an ease increases this year. Having said that, when you break down the number, it's not as clear. And the reason why is that 25,000 was broken into two parts. Your part-time jobs were down, let's call it almost 70,000, but your full-time jobs were up 45,000. That's a split that the Bank of Canada will not mind. And by definition, the full-time jobs are people employed throughout the year. When part-time jobs include like seasonal jobs, Christmas sales workers and the like. So the split of 45,000 full-time jobs being created is very good. So that kind of offsets the headline. So let's call that neutral. The second thing the Bank of Canada will look at is the unemployment rate. That dropped to 6.5%. That actually decreases the chances of an ease because it says employment is getting better. There's less unemployed people. Having said that, when you look under the hood again, it's not as clear. The reason why it dropped was not because of increased job creation, but because less people looking for work, as you mentioned before. The question is, why are less people? So again, although 6.5% is increases or decreases the chances of easing, the under the hood says, okay, that's neutral. And the last thing the Bank of Canada will look at is, what is wage inflation? Wage inflation, again, came in much lower than expected, 3.3, I believe, versus 3.7%. The Bank of Canada will like that. They want to see lower inflation that increases the chances of an ease. Having said that, we're still above the higher end of their range of 3%. So all in all, Bank of Canada on hold. They still have flexibility to ease later in the year. And that's what we just got to look at more data and look at the U.S. unemployment data next week.
Why would people have been dropping out of the labor force or stopping their search for work, Earl?
Yeah, there's a few reasons. One, it could be not disgruntled, but frustrated job seekers in regards to maybe they're looking for a manufacturing job, and you saw the numbers there. So just because they're not getting any leads, they might be frustrated and go on the sideline. Another reason might be education. Maybe people are going back to school. That would be a good reason, to retool the skill sets. So again, you got to look under the hood, see what the catalyst was. That's one of the things our team will be doing this week, just to see what the big driver of that is. That's where we have the biggest question.
What is your overall view, Earl? If you had to come down on a most likely case, how many cuts do you think the Bank of Canada will be forced into this year, if any?
We think one cut at most right now. We used to think up to two cuts, but again, the GST rebate is stimulative to the market. We're also very constructive on the U.S. market. An interesting fact, tax receipts in the U.S. for the month of January was a $60 billion surplus. That just speaks to the underlying strength of the U.S. And, despite the uncertainty, if the U.S. does well, we will do all right.
This massive drop in manufacturing jobs, or let's say a nasty decline, is that likely to be a one-month phenomenon? I know that's a very hard prediction to make.
Yeah, no, it's not a hard picture to paint. It's going to be until Kuzma is settled. Until those trade negotiations are settled, we will probably see we won't see growth in manufacturing job, and we'll probably see continued weakness. And the reason why is there's no medium or large size companies investing in manufacturing plants right now because they do not know the rules or economics of the investment. You will have a better sense of, what revenues could we expect in the next 3 to 5 years once you know what the agreement is between Canada and U.S. The reality is when a lot of larger companies come to Canada to create jobs or build manufacturing plants, they're not just thinking about Canada. They're definitely thinking about Canada, but they're also thinking about the U.S. and the possibility of exporting there. So until we get some clarity there, we expect to see, let's call it malaise in the manufacturing jobs. So that's not a surprise. We're not that number wasn't a surprise to us. It won't be a surprise to the Bank of Canada, but that's what we're waiting to see until we get settlement there.
So you think that Canadian 10-year bonds, for example, look like a reasonable buy right now?
Yeah, I think that's a good word that you use there, Andy. Reasonable buy. And the reason why they look like a reasonable buy, we're very close to the higher end of the range of 2025. So it's good there. One thing we would prefer to buy in Canada, rather than just a 10-year government bond, is a 10-year corporate bond. And the reason why is you get an additional spread, let's call it 80 basis points higher than your 10-year government bond. And we're constructive of the U.S. economy, which means Canada should do all right. There's also a tailwind behind fiscal spending to keep the economy going in Canada. So we think that's a positive as well. So that's what we would prefer. We don't mind that 10-year 5 to 10-year sector, but we would prefer corporate bonds to government bonds.
And we're just looking here. You have a suggestion for us, a 30-year Brookfield renewable bond.
Yeah, and you know what? We don't venture into the 30-year too often just because there's so many unknowables, let's call it there. But this is one we have a high amount of confidence with. Like we said, it's about 130 basis points higher than the 30-year government bond, but 90% of the revenues here are fixed. And 70% are inflation linked. So it gives you a high degree of certainty of not only the coupon being paid for those 30 years, but the principal being paid. So this is what we look at when we do venture further than 5-10 years from a corporate bond investment. You have to have a solid balance sheet, and you have to have a solid and known outlook in regards to the revenue growth in the future. And that's a very attractive one in our portfolio.
30 years. I mean, that's for a conservative part of your portfolio, 5.1% yield for 30 years.
Yeah, conservative, but and it's the highest part of the yield curve as well. By nature, the longer out you go, the higher yield you would get. It's also it's global. It's in renewables, non-carbon investments. So we like that theme as well as we go forward. So there's a number of good things behind this bond.
That was Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Well, coming up, we will dive into the Super Bowl and Winter Olympic ads that are worth watching, plus the trends reshaping brand storytelling. We've got more on that right after the break. The Super Bowl and Winter Olympic Games aren't just global sporting events, they are the biggest stages for advertising. This year, brands are betting high on splashy celebrity spots and emotional storytelling. So for more perspective, I'm joined by Bobby Distunis, president and co-founder of Panoply Media. It's good to have you join us. Thanks so much.
Yes, hello.
So I think let's start on that note about storytelling this year, because as you've noted, last year, it was more about like taking a political stance and making a statement. This year, not so much. Can you explain like the difference between what we saw last year compared to what we're expecting this year?
Yeah, what we're expecting this year is a return to what made the Super Bowl ads the Super Bowl ads, the iconic ads of the 80s, the 90s. People want to have fun. This is a big event. People are making time for it. They're organizing parties. They need a break from the current affairs, from the news cycles. So this is a great opportunity for brands to entertain them, to say, funny stuff and get their attention.
Why does the Super Bowl remain such like a major moment for investors? What is it about that day?
It's the reach. It's that one moment. There's one game in the year that gets 16 plus million Canadians in front of screens, that gets 130 million Americans in front of their screens. And everybody's captivated. They're watching it. It's fun. So it excites brands. Brands want to be part of it. They want to be part of a moment that if they could do something interesting and get their attention and get the people to say, hey, stop. Hey, let's watch this spot. That's what we want to get from the event, and then launch our products and our campaigns.
And that's exactly what we're seeing with some Super Bowl ads. Like you've noted one that you're going to be watching for, and that's an Xfinity ad that really features Jurassic Park. Can you tell us a little bit more about this ad and what it does so well to kind of grab in the viewer?
Oh, this is a great one. So it's clever. That's the first. It's funny. It's nostalgia. and it's a lengthy spot. And as an advertiser, it's a bit hard on a daily basis because we're pushing ads on social platforms, on platform, on streaming platforms, and you don't get much minutes or seconds to tell your story. This one, it's a +1 minute story. It's great. It fills up the entertainment and it delivers on the brand, the product, and the moment.
And it's nostalgia, right? Because you've got all the original main characters of Jurassic Park in this ad, which is pretty phenomenal. Like why do you think Xfinity decided to lean on nostalgia for this?
Well, it makes sense. Jurassic Park was a blockbuster of maybe 20 some years ago, and the fact that they're going back to nostalgia because the Super Bowl attracts different types of people, right? So you have all the demos, all different kinds of people, getting together to watch the big game. Well, you need to find cultural moments that can trigger interest in between them. So that one does it really well. You went and got a Hollywood production in Jurassic Park. You brought back all the stars. You layered in some tech, made them look great, young again, and you slipped in the brand in a very nice, clever way.
I was wondering how they made them look so young again, because they do look like they stepped right out of the movie from decades ago.
Oh, yeah, absolutely.
Yeah. When it comes to the Super Bowl, though, in terms of evolution over the years, how has the Super Bowl and advertising for it evolved since it started?
It's evolving every year. Maybe 10 years ago, it was all about that one moment, launch your spot, make an impression. Now it's not just about that moment. It's about the pre-moment, right? The before, building up to the big game. How many teasers could we roll out in the market? Because everybody that buys spots at the Super Bowl will do something interesting. So how do you get people interested before? Then it's making that impact at the moment. Like, hey, watch, this is a great one. Let's look at it. And then the post. And the post is the best action you can get is sharing an ad, telling a friend, hey, did you see this one? This one was interesting.
I want to get to the Olympics as well, because now we're into the Olympics as of today. These are another great spot of ads you see every year. You're watching a Lululemon ad. Tell us about that one.
It's a different stage, right? Super Bowl is something that comes back every year. They created an aura of fun, of party, versus the Olympics, where it's also a great stage, but every 2 years, every 4 years, depending if you're watching the Summer or Winter Olympics. And then there's another angle. It's not necessarily just fun. It's about competition. It's about, it's a patriotic moment. So brands that want to deepen their roots, that want to, brand themselves closer to Team Canada, then it's a great opportunity. And it's not a one-day event. It's a 2 weeks event, which gives advertisers time to build our story. So it's not make an immediate impact. It's rather, as you're binge watching different events, slip in the ads and just be relevant in all those moments.
Both those ads you chose today, really impactful, really interesting. That's all the time we have. Bobby Destounis, president and co-founder of Panoply Media. Appreciate your time today. Thanks so much.
Thank you.
Coming up, we will check in on the markets on Bay Street and Wall Street right after this. Stay with us. Market Call is coming up next. Today on the show, we have Lawrence Steinberg. He is the president at Lawrence Steinberg Wealth Management, and he will be taking your questions on global value stocks and high-yield bonds. And today on Trading Day, former BlackBerry CEO Jim Balsillie will be sitting down with Andrew Bell for a featured interview on data privacy in Canada and how that impacts the cost of living. That interview coming up at 1 p.m. today. Be sure to stay tuned for that. Okay, we've got a little bit of time, so we'll take another quick check on the markets before we wrap up here. We'll see how markets on Bay Street and Wall Street are trading today, starting with the TSX. It's looking up trading above a percentage point at this rate. Material stocks really helping to boost up the TSX today. If we look at U.S. markets, they've been boosted too. You can see all trading up at the moment by more than a percentage point. The Dow Jones up almost 2%. Of course, investors buying on the dip after that sharp sell-off in tech and software stocks that we saw this week. Some interesting stocks, though, to dive into a little further. Stellantis is one we're watching closely today. Of course, it's down more than 25% at the moment. The automaker has said it's taking a $25 billion write-down linked to its shift in EV strategy. It says it has sold its stake in a battery plant in Windsor, Ontario to LG Energy Solutions, and you can see investors reacting to that today. The share price has been bouncing around 24 to 26% down at the moment. And Amazon is another one we're watching closely today. It is sinking on the news of a $200 billion capex spending plan. Amazon at the moment is down by about 7%, almost 8%. A lot of investors fearing this kind of aggressive spending we're seeing from companies when it comes to AI spending, wondering when that will pay off. And you're seeing that results from Amazon today. Investors a little wary about that. That's it for us. Thanks for watching Morning Markets. We will see you tomorrow or Monday.